Hey tanker enthusiasts, ready for your weekly dose of market intelligence? You have tuned into the right place. This is the weekly Tanker Market podcast where we break down the complex world of tanker shipping into bite-sized pieces. We will cover everything from the latest fixtures and freight rate fluctuations to the big puncture trends shaping the industry. Today with me, Sandesh, our expert on the oil, gas and tanker market. Welcome, Sandesh.
Thanks, Sounakh, for inviting me once again. We have a lot to discuss about tanker market.
Okay, Sandesh, the tanker market has been a roller coaster lately, with VLCC surging and then softening, Suezmaxes showing similar volatility, and Aframaxes struggling to find direction. Can you break down the key trends across these vessel classes, highlighting the factors driving these fluctuations and what we can expect in the near term?
Well, Sounakh, you are right. It's been a wild ride in the tanker world. And let me start with the VLCCs. They are the giants of the sea, right? Last week, it began with the bang, a sudden surge in cargoes defying the, kind of a usual Lunar New Year lull. And think of it as a pent-up demand explosion. Major players like Mercury, ADNOC, PTT, Unipac, and then Hanwha, Total, they all kind of jumped into the fray and they kind of snapping up tonnage and sending freight rates soaring. So increased activities from West Africa, Brazil, and then US Gulf Coast. It's kind of a further tighten the screws on the supply. It was a classic case of too much cargo and it kind of a chasing too few ships. Then we have owners, they kind of smelling blood in the water and push rates even higher. So the market was squeezed. Off-market fixtures and bad weather, they kind of further reduced the vessel availability. It was like a perfect storm for owners. But then we know as week wore on, the market, they took a breather. Rates kind of softened and, a touch that has been there, it has gone, and the charterers tried to regain control of the market, but owners, they kind of held firm on their rate expectations. So things got a bit quiet on the surface, but behind the scenes negotiations, they kind of continued. So the expectation is that the rates will likely hold steady in the coming week. And moving to the Suezmaxes, it was a kind of a similar volatility like earlier I have explained about VLCC. In Suezmax, we have witnessed the same thing, exactly same thing, just bit here and there. So the market is the Suezmax market is started strong and it buoyed by a kind of a firm West Africa sector and the rising VLCC tide. So mid-February cargo inquiries they were already being whispered about, and midweek as soon as like VLCC here also things get kind of a stabilized, but then rates for the eastbound voyages they kind of softened due to lack of fresh inquiries. So westbound rates surprisingly ticked up kind of a slightly despite stable supply, and by the week's end the rates were easing lower amid subdued demand. So the anticipated spillover effect from the VLCC market, it failed to materialize. And then we have a healthy tonnage list that kept a lead on, any potential rate firming. So the Suezmax market, it is now waiting for a fresh influx of cargo inquiries to, kind of reignite that activity. So that was about the Suezmax market. Now let's talk about the Aframaxes. The MEG market, that is Middle East Gulf market, it was dead quite all week and there was very minimal reported activity. The TD8 index, it's a benchmark. It reflected this lack of demand. They started gradually declining. So rates, they overall softened, limited modern tonnage availability. It kind of offered some support, but it was negligible. Slow inquiries and balanced supply list, they overall kept sentiments also stable. So here we have a TD14 index that drifted downwards and it kind of mirroring the weak demand. So owners were eyeing on a potential westbound voyages, but the lack of inquiries, they kind of prevented any upward momentum. So growing vessel availability, then it further added to the market softness. Now owners, they are kind of hoping for a pickup in the activity in the latter part of February. So in terms of key indices, talking about from the perspective of VLCC, we have a TD2 and TD3C. They both kind of saw significant week-on-week increases, while TD15 also rose. So TD22, however, saw a smaller increase. Indian PSU, they were largely absent from the market. Quoting a few, but not that much. So for Suezmax's TD6 and TD20, they both increased week on week, and Indian PSUs, they quoted a couple of cargoes in this particular segment. With the last one, it was covered at a specific world scale rate. So Aframax TD8 and TD40 indices both decreased week on week, and even here also Indian PSUs were again quiet, quoting no cargoes at all. So overall, the tanker market experienced a week of mixed fortunes, with VLCCs and Suezmax showing volatility and Aframaxes struggling to find direction. So the near-term outlook hinges on the cargo availability and kind of a charter activity. So you have to see from this perspective that it's a market where patience and strategic positionings are key.
Okay, well said, Sandesh. Let's now shift gears to our next segment, weekly tanker market sentiment. I have seen data indicating robust oil consumption growth in India for the January 25. The clean tanker market seems to be sending mixed signals. We are seeing some rate fluctuations across different vessel classes and trade routes, coupled with interesting developments in product demand and arbitrage opportunities. Now, can you unpack these complexities for us, giving us a clearer picture of the current market sentiment and the key factors driving these trends? And how has this influenced the overall product tanker market's performance? And what are the prevailing sentiments we are observing?
So Sonak, you are a spot on, and it's a bit of puzzle out there in the market. Let's dive into the details. Let me start with the long range segment. We are seeing a tale of two tankers. We have a LR1 freight rates on XAG Japan route. They have kind of taken a slight dip, down by world scale 3.44 points week on week, and it translates into the kind of a marginal decrease around $447 per day in earnings. So you know what, it's a sign of softening sentiments in that size class. Now the larger LR2s, we have a TC1 75K XAG Japan. They are feeling the pressure even more acutely. They have seen a much steeper drop, the whole world scale 21.66 points week on week, with earnings they are kind of plummeting by more than $7,000 per day. And that's a significant 72.61% decrease. So it clearly indicates that the larger vessels, they are facing considerable headwind moving to the medium range. So that was about the LR tankers. Now let's moving to MR segment, that is medium range segment. It's a similar story of mixed fortunes. Here also we have one benchmark TC12. It is weakening down by world scale 2.5 points week on week, with earnings also taking a small hit. However, there is a bright spot that, TC70, another benchmark route, XAG East Africa, it is showing some resilience, with rates marginally climbing by world scale 4.29 points, and earnings also approximately rose by $1,000 per day. So this suggests that demand or tonnage availability on this particular route is holding up better. Now zooming out to the bigger picture, India's oil consumption, and that you have mentioned in your question, so let me have some layer on it. India's oil consumption data shows a clear picture. January 2025 saw a healthy 3.1% year-on-year surge in aggregate demand, and it reached around 2.489 million metric ton. So this is a monthly demand I'm talking about. So India is kind of a crucial demand center, and this growth, it underscores its importance. So in CPP we have kind of an important commodity, that is diesel. It increased by 4.2%. Then we have a gasoline, it jumped by 6.7%, and then LPG, also a kind of a vital residential fuel, it was also up by 5.4%. So even more striking was the 19.1% surge in petcoke demand, suggesting robust industrial activity. However, we have naphtha demand, it contracted by 12.4%, and possibly reflecting a weaker petrochemical margins. Then we have aviation fuel demand, which also rose by 9.4%, mainly due to, this Kumbh Mela and the kind of different activities due to year end, and then the festivals are there. So overall, we are seeing that there is significant increase in the CPP demand segment, and that could support MR tanker demand in the region, because most of these cargoes are going through coastal voyages, and they are supplying the demand areas from the production areas. So this strong consumption in India, it suggests a healthy refining margins, and then the ton mile demand for product tankers on West Asia India routes. This is, I'm talking about imports. So looking at the clean tanker market east of Suez, there is a kind of a sense of cautious anticipation. So the LR2 market, as we discussed, it seems to have a potential bottom, with the AG Japan naphtha fixture hinting at a kind of a tightening tonnage. So the LR1, LR2 premium, which had compressed, is now back to the more normal levels. So MR rates, they are showing some resilience across the Atlantic, though it's kind of a different picture. So America's MR rates, they are kind of under pressure due to low activity, and ample tonnage is available in the US Gulf Coast. So it's again demand and supply equation. So the multi-option fixture, there is clear sign that charters have the upper hand. And finally, the refined product market, they throws in some interesting curveballs. So we have ARA gasoline stocks. They are now at record highs, and these are mostly driven by seasonal factors, kind of a reduced West African demand and anticipation of future arbitrage opportunities. There is a play by traders and, market enthusiasts. Now, transatlantic gasoline flows, they have increased significantly, although, we have a Canadian export. They are also playing a key role. The refinery disruptions that we have talked earlier, specifically in the US Gulf Coast, they added a further complexity to the situation. You know what, Sonak? It's a market with a lot of moving parts. And we are seeing a mix of strengthening and weakening rates, kind of a depending on vessel class and trade route. But having said that, India is a robust demand, is a positive sign. But the global picture is more nuanced, and the interplay of product stocks, arbitrage opportunities, and then the regional factors, they are kind of creating a complex and dynamic market that requires careful observation and analysis.
Well said, Sandesh. Now, what I have observed is the tanker market east and west of Suez seems to be telling two different stories. Eastbound rates are under pressure, while westbound activity is picking up. But there's still a lingering tonnage overhang. The tanker market is indeed a play of contrasting narratives right now. East of Suez, we've seen a definite slowdown this week. It's been a quieter affair with only 3 deals linked from the AG for late February shipments. Think of it as a bit of a lull after a period of activity. And this lack of activity has translated directly into downward pressure on rates. We have slipped below that crucial $50 per metric ton threshold, with rates on the bellwether Ras Tanura Shiba route settling in the high $40 by the end of the week. Even the usually active Indian PSUs haven't been able to prop up the market. They have secured a couple of end February vessels, but even those fixtures were in the mid to high $40 per metric ton range. Can you please unpack these regional dynamics for us, highlighting the key factors influencing the freight rates and what we should expect in the coming weeks?
So Sonak, thanks for that question. The real kicker here is the sheer number of vessels. Those are still stemming towards the region, and they were expected to arrive by the end of February. So now you have to combine that with a fixture count of 19, which is already above a 3-month average of 16, and you have got a recipe for the further rate softening. So it's a classic case of too many ships and they are chasing too few cargoes. So the market's attention is now shifting to March fixing, and the hope is that the fresh demand will emerge to absorb this available tonnage. So west of Suez, the picture is little different. Though it's not kind of entirely nosy, we have seen kind of a healthy activity for early March loadings. With the multiple fixtures, they are reported from the US Gulf for late February and then early March dates. So there is definitely some demand out there. However, the ghost of February's tonnage overhang continues to hunt the market. And there is just too much available capacity. This is keeping a spot rates under pressure. We are seeing rates in the low mid 90s per metric ton on the Houston-Chiba route via Panama. So fog-related delays in the US, they kind of are not helping matters either, because, it kind of pushing schedules back and then adding to the uncertainty, while there are some, tightening factors to play, increased inquiries, COA programming, and Cape routings. There is still enough open tonnage to keep the market sentiments flat to soft, and it's a kind of a bit of tug of war. So increased activity is trying to pull rates up, but then the lingering tonnage, it overhangs and is kind of holding them down. So Sounakh, what's the takeaway? East of Suez, it's a market facing downward pressure due to combination of subdued activity and ample vessel supply. While we have a west of Suez, there is a more activity, but then the tonnage overhang is keeping rates in check. So both markets, they are looking ahead to March fixtures, and they were hoping for a demand surge to balance the scales. So it's a market where careful monitoring and strategic positioning will be, they are kind of crucial in the coming weeks.
Well, Sandesh, that's all the time we have for today's episode. Thank you so much, Sandesh, for your insights, and thank you to all our listeners for tuning into this week's Maritime Update. We'll be back next week with more updates from the shipping world. Until then, keep navigating the waves of the shipping market.
Thanks, Sounakh. It was a pleasure to be here, and I'm looking forward to next week's discussion.
Take care, everyone. Stay safe and keep sailing smoothly.